Hi class, today we're going to be doing exercise 811 and we are given a list of transactions that took place for Medlock Inc. in both 2016 and 2017. And what we're going to be doing today is to record the transactions in the general journal, and then the company does not make entries to accrue interest except at December 31st. So in 2016, on May 1st, we received a $3,712 month 3% note in exchange for an outstanding account receivable from R. Stoneley. So what we're doing is we're transferring this accounts receivable into notes receivable. So we'll start with the date, May 1st, 2016. And then first we'll be debiting notes receivable. And crediting accounts receivable. And this would be the total amount of the note, so that was $3,700. Then on December 31st, 2016, we accrued interest revenue on the R. Stoneley note. So first we start with the date. And here we are receiving interest revenue, which would be the credit, but for the debit, it's going to be interest receivable because we incurred this revenue, but they have not yet paid it. So that is why it is interest receivable. Interest revenue, once again, is the credit. But to figure out the amount that we're going to debit and credit, we need to use the interest formula, which is the face value of the note times the annual interest rate times the time in terms of 1 year equals the interest. So the face value of the note is $3,700 times the annual interest rate, which is 3%, times the time in terms of 1 year. So this happened December 31st, and we incurred the note, or that note originally happened May 1st. So that is 8 months out of the year. So we're going to do 8 divided by 12 because it's times in terms of 1 year. And when you do that calculation, it equals $74. So we are going to debit $74 to interest receivable and $74 of credit to interest revenue. Finally, on May 1st, 2017, we received principal plus interest on the R. Stoneley note. And we need to note that no interest has been accrued since December 31st, 2016. So first we can start by writing the date, May 1st, 2017. Now, the 4 accounts we're going to use are cash, notes receivable, and interest receivable, and finally interest revenue. So first, what we know, we have to credit the amounts, the total amount of notes receivable that we did in the very first journal entry. We're going to have to credit that complete amount of $3,700. Next, the interest receivable that we received last transaction is now going to be credit as well. But we need to recalculate another interest revenue that happened from the beginning of 2017 all the way through May 1st, 2017. So it's the exact same notes receivable that we're talking about. So the face value of the note is still $3,700. The annual interest rate is still 3%, but the months have changed. We are only doing this from January through the beginning of May, so that is 4 months. And you divide that by 12 because it's only 4 months out of 12 months of the year. And that turns out to be $37. So that is the amount that you will credit. Once you add up the notes receivable amount, the interest receivable amount, the interest revenue amount, you will receive $3,811. And that will be the amount of cash you'll receive from the notes receivable, the interest receivable, and the revenue you made off of the interest from the note. And that is all for this exercise. Thanks for watching. Hope you can figure it out.